What's happening to BiggerPockets? It's Matt Faircloth. So we've had a few conversations on my YouTube page, which you can get to by going to youtube.com/DeRosa Group. And on that page, a lot of folks have talked about paying down their mortgage. And I shot a video on that page. It was so popular that I wanted to share that, go into a deeper dive of the conversation here so everybody's clear on what the strategies of mortgage pay down should be. Okay, so let's jump in. So this actually plays on maybe on your home. If you guys own your home, this conversation, some of the part of this conversation will play, and this will obviously play on rental properties that you guys may have. Okay, so when I say mortgage pay down, you've got your mortgage payment. Okay, let's make a P right, Matt. There you go. Okay, payment. Okay, and that's breaking the mortgage payment's likely broken down into two different things. There's the principal, and there's the interest. Okay, now your mortgage statement you get from the bank is going to tell you, you guys should look at it and see how much of that money goes to principal, how much of it goes to interest. Now there's other stuff that may be in there, especially if it's your primary residence, and some banks will do this for rental properties where they're going to pull out another line item called escrow. We're not going to talk about that today as much. I'll just tell you what that is, but it doesn't have to do with paying down your mortgage. All escrow is they're taking some money and they're going to put it toward, they're going to pay your real estate taxes and maybe even your insurance for you. And if this is a big apartment complex, they might even escrow for future repairs that you might have to make, called capital expenses. So those are all parts of your mortgage payment. We're not going to talk about this guy today because it doesn't really have to do with paying the mortgage down. The conversation that we're going to have today is around these two guys. Okay? Now, if you're paying your mortgage down aggressively, what you're doing, if you want to pay your mortgage down faster, then you're paying more of this. Most mortgages are set to get paid down over something called an amortization schedule. Please don't tell me if I spelled that wrong. Amortization schedule, okay? You probably can't read my handwriting anyway, but it's okay. Amortization schedule is somewhere between, I mean, you could hear of like a 40-year amortization, but it's likely somewhere between 30 years and all the way down to maybe even 15 or 20 years. But let's put 15 as the absolute lowest that it could be, right? Get back on there. 15 years. All right. Okay. 15 years, okay? That is how fast the principal is getting paid off, and what that means is after, say, 30 years, the home is free and clear, or the property is free and clear, and it's paid off completely, okay? Amortization is just how quickly it gets paid. Now, by logic, as you go and own the property longer and longer, this principal pay down over time goes up, and the interest that you have to pay goes down because as you pay the principal off, you owe less money on the property, okay? So the amortization curve tends to look like this, where in the beginning, okay, in the beginning of the property, this is how much your payment is, right? And in the beginning, your interest that you pay is all the way up here, and the amortization amount, your payment's this, okay? This is the payment. Payment doesn't really change, okay? In the beginning, this much of it is interest. Oh, that stinks. In the beginning, this is all interest, and this is principal, meaning like your payment could be $1,000, and 50 bucks of it could be going to the principal, and 950 could be going to interest. Might be exaggerating a little bit there, but it's heavy like this. And as you pay the property off, in the beginning it kind of looks like flatline, but then it starts to get aggressive over here like that, right? And so you're paying less and less interest because you owe less. You're paying the property down over time. More and more principal's going to paying the loan off to where you're down to zero and you don't owe anything on the property anymore. That's an amortization curve. Now what some people will talk about is applying more principal to their payments. So they don't pay this as their payment. They'll throw in a little extra on top and they'll start to aggressively pay this down. And strategies like this makes this curve look like that, okay? Or even, you know, whatever. It's somewhere in here. And this is time, okay? Right? So if I can put more money on the mortgage, I'm obviously paying less interest and the principal kicks up and everything like that. So I can pay the mortgage off maybe in 15 years or 20 years when it's really a 30-year amortization. I'm paying it off in a shorter time frame, okay? This is the concept of aggressively paying down your mortgage. This is what it looks like. This is the chart on how it would go for you to do that. And it's simply just paying more principal over time. Here are the questions around that, okay? From a tax perspective, there is no advantage to paying down your mortgage faster, okay? Let's all get that in the air because some people think that there's tax advantages to do it, okay? from a strict looking at income and expense perspective, your mortgage payment all in, let's say, like I said, you're paying $1,000 a month on a property, okay? That entire payment is not tax deductible. The only part of your mortgage payment that's tax deductible is this guy. It's just interest. The amount of principal you pay is not tax deductible. That's all just you paying back a loan, and loan repayment is not a expense line you're allowed to claim on your income tax. So paying down your mortgage aggressively doesn't give you more of a write-off. It just pays back a loan so you can own the property free and clear at some point. But this principal, like let's say you've got a property that's cash flowing at $2,000 a month. Okay, you've got $500 in expenses. Okay, so that means your net operating income is $1,500. Okay, your mortgage payment's $1,000, like up here, right? That means your net cash flow, money you get to put in your pocket, is $500, okay? But your taxable cash flow is whatever of this is at whatever interest you have here, okay? You follow me? So the interest might be, let's say this is 500 or 600, whatever it is. Only the interest gets taken off of this on your profit and loss statement. Hope you guys are still with me. But what you could do in this circumstance is if you got this $500. If you're not living on that, one strategy on aggressively paying down the mortgage is to take this, let's say this breaks down to like $600 in interest and $400 in principal, okay? Okay? What a mortgage pay down strategy would look like on a rental property, not your home. If this was your home, this would just be money coming out of your pocket, out of your income that you would use to pay down your home. But if you're doing this on a rental property, you would just take this $500 and sling it towards the principal and send the bank an extra $500 a month. The thing is, this is taxable and this is taxable. So you're going to have to pay the IRS at the end of the year for 900 times, per month worth of actual income, because the interest is not taxable. Okay, or interest is taxable, this is not. But you could sling this 500 here and then create a scenario like this on a rental property. Now, if the strategy of paying down aggressively, okay, this is a pay down aggressive thing, and if you want to get even more aggressive, maybe you take $300 out of your pocket each month and sling it over here too, and then before you know it, not before you know it, but within like say 15 years or so, you own this rental property free and clear, and you're making $1,500 a month for yourself instead of all this. That would be the reason you would do that. But the pay down aggressive strategy has a few pros and cons. Okay, this pay down aggressive just means just slinging extra money at the mortgage each month, whether it's out of your own pocket or whether it's out of cash flow. You guys with me? Okay. I can't hear you anyway, so you don't have to say yes. But if you're with me, shake your head. Okay, cool. Pay down aggressive, it benefits you if you're not living, if you don't need the money to live, okay? Okay, so if you need the money to live, the cash flow, if you're living off your rentals, then this is definitely not a good idea. You want to keep as much of this as you can so you can increase your living expenses and use the money now versus paying the property off years from now so that you can benefit it in the future. Okay, the pay down aggressive model works best if real estate investing is not your full-time gig. Okay, if you are doing this part-time or on the side and it's not, and it's like let's say it's part-time or passive. Okay, like if you bought a turnkey property or something like that, or if you bought a rental property that's over here and you just don't need the money, this is more of a wealth building strategy for yourself. If you're doing that, then you want to aggressively pay down this property as fast as you can, because it'll benefit you in the long term. Then maybe this could be part of your retirement program or something like that, to start living on the cash flow from your rental properties, and they're all paid off. If you transpose yourself out years from now, when this property is paid off free and clear, you get to keep all this. Maybe your expenses went up a little bit, but your rent did too. But either way, you're keeping $1,500 a month once the property's paid off. Okay, that is the aggressive pay down strategy. Okay, now the other strategy here is if you are living on this, there's another. Now some folks get squirrely when they talk about it, but I'll talk about it anyway, and that's going interest only. Now, there's some folks that I know, because I was around before the crash of 2007, 2008. that were on aggressively interest-only mortgages that had super low floating rates and teaser rates, and there was even a mortgage called a negative amortization mortgage. I'll try and explain that really fast, but that's definitely not something that exists anymore. But before 2007, that's something that was very common. The way a neg am looks like is in a circumstance like this, where your interest was $600 and your principal was $400, you would only pay about $400 a month. In this same circumstance, owing the exact same amount of money, you'd owe $400 a month, and what the bank would do is they would take that $200 that you didn't pay, and they would increase the loan amount, increase the amount of money you owed on the mortgage by $200 a month. So your principal balance, the amount of money you owe, is actually going up as you own the property. It works real good in a rising economy, and an economy where properties are going up in value, and nobody thought the party was going to stop anytime soon back then. So people would have negative amortization mortgages, so your only cost would be $400 a month. This is not something you want to do. This is something that's like a ticking time bomb, but that's like a little history lesson on negative mortgages. And so those of you guys that have been out there for a while, that's something that was around. Interest only is a way you could go, where you would only pay $600 a month on this property. Well, hey, that's great, because instead of making $500 a month, you're now making $900 a month, right? And not for nothing, you got to pay tax on that anyway. You don't get to keep the, you don't get to write off that $400. So you're paying tax on the $900 on the $400 anyway. So on an interest only mortgage, you get to take $900 and put it in your own pocket. Okay, interest only works if you are relying on the cash flow for your personal expenses and you're trying to get out of the rat race as fast as you can, and you're trying to live on this. It is not a long-term wealth building strategy. It is the opposite of that. It is a short-term strategy to get enough cash flow. Okay, so the comparison here on paying down your mortgage, and what you need to think about is personal cash flow or wealth building. Now, you can do both. You can wealth build while you do cash flow. Maybe there's a strategy for a few properties you pay down aggressively and a few properties that you take the cash flow on or something like that. But the pendulum swings more towards cash flow or wealth building depending on which way of these you decide to go with, okay? There's other factors that play in here that I didn't get the chance to talk about earlier when I shot a quick YouTube video on this on my channel. But it has to do with how long this interest rate here is locked for. Like, let's just say you're paying 5% today, okay? If this is your single family home, you might be paying 5% for 30 years, forever, right? If this is a rental property, or if this is a property that that's a short-term loan, like like maybe any commercial loan or a rental property loan that's provided to you by a small community bank, is likely going to be where this interest rate's only good for a certain period of time. Most of the time that rate's only good for, say, 5 years, 7 years, maybe 10 years on the property. That's not the amortization schedule. That's just after the 5-year rate lock is up. Okay, they're going to adjust that rate. It's not like an adjustable rate mortgage where it changes every month, but after about 5 years, that interest rate might go to 7, it might go to 4. Luckily not going to go down, but it's going to go to, like, say, 6 or whatever. So what you can do is pay down the mortgage a little bit, and maybe instead of, like, if you're paying the full mortgage here, instead of paying like $300, $400 towards it, maybe throw an extra $50 towards the mortgage, just slowly trickle it down a little bit, just a little extra, so when that 5-year time frame comes up, you've given yourself a little bit of a hedge. Okay, most banks are going to want you to start paying this down eventually. They're not going to give you interest only forever, you know. So when you do start paying it down, it's okay to start throwing a little something at it to reduce the principal balance long term on the property. Okay, but the decision you guys need to make in your properties, bottom line, it is cash flow versus wealth building. And there are strategies out there. There's a lot on BP that you guys can check out about how to aggressively pay down and what these charts look like. The more money you put, like what the strategy is, how often, like, you know, how much you put towards it to hit a 15-year time on a 30-year property. Really great to do on your single family home. It's great to do on rental properties where you don't need the cash. That's what I got. Throw some more strategies, some more comments down in the box, and we can have a chat about it. Always appreciate you guys watching. Don't forget to check out my book, Raising Private Capital. BiggerPockets gave a discount code on it. Live Private Money. If you guys are interested in picking it up, you can get that at the BiggerPockets store for 20% off. Use that coupon code. Thanks for watching, guys. Appreciate you always. Have a great, profitable week.